What should you do with your RRSP if you're going to be moving to the United States for a limited amount of time? I'm Lucas Wennersten with 49th Parallel Wealth Management. Down here on the bottom right, we've got the combined provincial and federal Canadian tax brackets in the province of British Columbia. And up here on the top left, we've got the US tax brackets, federal, no state tax brackets. And we're going to ignore state taxation altogether for this discussion because there's too many states and too many different tax brackets. Some states don't have tax at all, income tax anyways. So we're going to ignore that. As you will see, the Canadian tax brackets are more compressed than the US tax brackets. And when you combine federal and provincial tax brackets, often you can end up paying higher rates of tax at lower levels of income in Canada. When you move to the United States, if it's going to be for a limited period of time, it could be anywhere from 1 year to 20 years. I'll talk about both strategies here in just a second. You probably want to leave your RRSP alone. I have heard of people taking complete full RRSP distributions before they move to the United States. I've heard people say they didn't want to deal with it or they thought they had to or whatever, but that's not the case. You don't have to take a full RRSP distribution. There are custodians in Canada that will allow you to have a US address on the account. And there are cross-border advisors like myself that are duly registered that can manage your assets both in Canada and the United States. That's very convenient if you want to try to maintain the tax deferral or the tax-free status. If we're talking about Roth IRAs, you can do that on both sides of the border if you're working with the right. Let's focus on this box right here. From a US perspective, when you receive an RRSP or RIF distribution, only the unrealized gains are taxable as foreign income on your US 1040 tax return. Contributions, interest, dividends, and realized capital gains can be distributed tax-free as a return of capital. It makes no sense the way they do it here in the US. They tax Canadian RRSPs similar to the way they tax US brokerage accounts. Of course, with an RRSP, the tax is paid on the distribution, whereas on a brokerage account, the tax is paid from a capital gains perspective anyways on the sale. So it's a little weird in that way, and it doesn't make sense, but that's how they do it. So that's how the US looks at things. And so since only the unrealized capital gains are going to be taxable from a US perspective, what you can do to avoid US tax, at least in the first couple years, or at least the first year anyways, is to sell everything in your RRSP, at least everything that's in a gain position. Again, those positions that are in a loss position, you can actually carry that forward to the United States. But just to make it easy, it's generally easiest to sell everything in your RRSP before you move to the United States. They refer to this as crystallizing the basis of your RRSP. I didn't make up the term, and I don't know why they picked that. But basically, if you sell everything in your RRSP before you cross the border and you enter with only cash, then from a US perspective, only the growth in the account from that point forward is going to be taxable. From a Canadian perspective, they move to a withholding system. So on periodic payments, which is anything up to 10% of the account value, which is the closing value from the year before, or up to 10 times the minimum RIF payment, whichever is greater, will be taxed at a 15% withholding rate. This is a 15% withholding on the entire distribution, not just the gains part. So that's what gets a little bit confusing, is because Canada's taxing the entire distribution. The US is basically prorating the taxation as foreign income based on the gains versus what would be considered a return of capital. If you distribute anything more than what would be considered a periodic payment, that's considered a lump sum. You'll be paying 25% on that distribution. So for most people, whether you're staying 1 year or 20 years, taking a distribution with a 15% withholding rate is usually kind of a no-brainer. Even if it's going to be a long time before you start taking RRSP distributions, and even if you're in that lowest tax bracket in Canada, you're still probably going to be okay. I mean, you are creating a little bit of tax drag, and maybe I'm wrong here, but for most people, they like paying 15% versus 20% regardless of when they're going to pay it. Now, if you're in the 23 or 28% tax brackets, maybe you want to take a distribution, maybe not. I mean, probably not at 25%. At 15%, it may make sense depending on how long it's going to be before you actually need the money. If it's going to be 30 years and you're at 22%, I would say no. There's a lot more analysis that needs to go into this, but it's it's iffy if you want to do it if you're at that tax level. Now, if you're at 31 or 33%, you almost definitely want to take that distribution with a 15% withholding. Maybe you want to take one at 25%, maybe not. If you're down in the United States and you're working and then you're going to be moving to Canada to retire and you're going to start taking distributions from your RRSP immediately, then you probably do want to take that distribution at 25%. 25% this year sounds a lot better than 33% next year, right? So that's kind of the thinking behind that. Now, if you're in the 38% tax bracket in Canada or higher, almost always you're going to want to take that 25% distribution. Again, there are instances where it could be a really long time before you're going to need that money. Maybe you're never going to need it, but one of the things you got to take into consideration when you're talking about moving back to Canada is that you become subject to the Canadian deemed disposition tax again, rather than U.S. estate taxes. So what happens, and I'll ignore spouses because you can pass RIFs and RRSPs to your spouse tax-free in Canada. But if we ignore that, RRSPs are taxable upon the latest death or the last death between spouses. So at some point, this RRSP is going to be taxable. And if you've got a big balance, let's say you've got $1 million RRSP, even if you move back to Canada and you start taking your minimum RIF distributions, you still might end up paying 53% on a large chunk of that RRSP, because if you die 10 years after you move back and you haven't distributed a significant part of that RRSP, you can see here you hit the top tax bracket at $260,000 approximately. In fact, as low as $178,000, you get up to 44%. I mean, that's much higher than most people, particularly people who are used to U.S. tax rates, want to pay. So this strategy will work for anybody that's going to be moving from the Canada to the U.S. and back again, regardless of how long it's going to be that you're in the U.S. You should consider taking RRSP distributions. There's a lot of planning that can go around that, and obviously you can optimize these strategies. I'm just talking in very general terms right now to try to put the idea in your head that this is something you should think about. The devil is always in the details. Make sure you talk to somebody who knows what they're talking about. It's best if you work with somebody who's done it before. Here at 49th Parallel Wealth Management, we call this retirement income sequencing. And so that basically means if you have RRSPs and RIFs and LIFs and IRAs and 401ks and Roth IRAs and taxable accounts, which accounts do you take distributions from to optimize your tax situation while still providing the income you need in retirement? That's what we're good at. That's what we can help you with. If you need help, give us a call. I'm Lucas Wennersten. From the desert to the tundra, we are your cross-border retirement experts.